more now on the markets. For that, we're joined by Margaret Patel, portfolio manager with Wells Fargo Advantage Funds. She manages more than $1 billion in equities and bonds. Also back with me, Jon Erlichman and Dominic Chu. So, Margie, it's interesting to kind of see what's going on in the markets today. Equity markets are firming up a little bit. Treasury markets, currency markets. I mean, it seems like back to normal. I mean, much ado about nothing in terms of what we got from S&P yesterday?
I think so. I think the market is saying that's further off, and maybe it'll encourage a little bit of agreement in Washington to try to handle the deficit long term.
Well, and it's interesting. We just talked with the Treasury Secretary. I mean, he certainly seems to think it's moving along. And I talked to a lot of folks yesterday who, kind of just blew off what we got from the S&P and just thought it was kind of interesting.
I'll take the opposite side of that. I spoke to people yesterday who said, you know what, the next 3 months could be tough. Janney Capital Markets did some research earlier this year, and we were citing it yesterday, which they looked back at similar situations, credit rating actions in Japan, in Spain, and they said their numbers and people they spoke to, part of a survey, would suggest that maybe the stock market might sell off to the tune of 6% over the next 3 months, that equities and corporate bonds would both get hit harder than treasuries because people have been loading the boat.
Well, it's interesting, Margie, if you look at you watched the price action yesterday with treasuries, right?
Yes.
We saw that initial spike up. It was a huge spike up in 10-year yields. And then gradually, as the afternoon progressed, we saw people coming in and buying up that yield all the way to the point where the treasury bonds were higher than they were going into it. What does that say? I mean, this is the return of rational thinking, right?
No, what it says to me is people are still hungry for yield. If treasury rates go up a little bit, there are plenty of risk-free buyers that want that extra yield. It tells me treasuries are still in a trading range, and it's way premature to think we're going to see big pop-up in treasuries.
But what do you think? We just heard from Larry Fink in the last hour saying that if you saw treasuries at 4%, we saw treasuries at 4% in the spring of last year when a lot of Asian buyers came in and swooped up that 4% 10-year yield. Now, is that going to happen again, or do you think it's just on its kind of way down again?
I think that's what's going to keep it from getting to 4%. There are too many people that want that, especially when we still have our core rate reported around 1 or 2%. So there's still a lot of time, and I don't think we'll see 4%.
We are spending so much time talking about the deficit and what's going on in Washington. What, though, really drives your motivation at this point? Is it the economic backdrop? Is it corporate profits? We're in the midst of corporate earnings season. Is it the news out of Washington?
Yeah, I think it's the corporate reporting season that's really going to drive the stock market here. And I think we're going to see a little disappointment. I think the big question is, what about cost push? How are people being able to pass on the price increases they've had? Will we see any disruption from Japan more than what we've already expecting? And I think we may see a few disappointments. So I would think we ought to have our 5% or so correction in the next 3 months, personally.
And guys, it's a busy, busy week for earnings. I mean, we're going to hear from a slew of companies from a lot of different industries. We'll get a real indication.
In the S&P 500, John.
Yeah, and look, what have been the best performing stocks this year, Dom? I think the energy group and
doing well.
Energy companies are benefiting from higher oil prices, but of course, at the same time, their costs are going up too. You're basically alluding to that.
That's right. That's right.
And you like energy, don't you?
I like energy because I think they're the companies that have a good finding record will do well, and higher prices mean higher profits. And their input costs have been all right. They've been able to pass those on. So they're in pretty good shape, I think.
Now, when you talk about stocks here, your stock picks are more conservative, so to speak, right? You're talking about those larger cap names, possibly less cyclical, let's call it, right? So how are you positioning? Is it just with those big blue chip names right now?
Well, I have some big blue chip names, but more I have in the mid cap area. I'm looking for growth companies or companies that have some leadership niche, especially in the economically sensitive sectors, because after this pause, I think their earnings are going to continue to be stronger than more consumer-related companies.
But you don't want to expose the consumer right now.
No, I think there isn't going to be enough growth there. We still have high employment. We still have stable wages.
So we see those housing numbers even today. They're still very volatile in terms of what we see.
Yes.
Margie, thank you so much. Margaret Patel joining us.